Welcome back to Big Picture Investing. I'm Kevin McCormick. Today we are breaking down Alphabet's Q2 2026 earnings, and we have a classic Wall Street paradox on our hands. The bottom line up front, Google's parent company just delivered an absolute monster of a quarter, record revenue, a staggering earnings beat, and yet the stock crashed nearly 7% intraday. It's a textbook sell the news event driven entirely by AI spending anxiety. But if you look under the hood, this sell off might just be setting up the most asymmetric buying opportunity in big tech this year. Let's get right into the numbers because they are historic. Alphabet reported Q2 2026 revenue of $119.8 billion. That is a 24% increase year over year, completely blowing past Wall Street's consensus estimate of $116.5 billion. Google services revenues, which includes search and YouTube, increased 15% to $94.5 billion. So why is the stock down over 6%? We have to look at the capital expenditures, the CapEx. The culprit for the sell-off isn't the earnings, it's a massive $15 billion CapEx hike that Alphabet announced on top of their already elevated AI infrastructure spending. Total capital expenditures basically doubled year over year to just under $45 billion for the quarter. The market is running the exact same playbook it's been using on every hyperscaler this cycle. Wall Street is demanding to see the immediate return on investment for this AI ambition. Investors are terrified of overbuild. They see Google buying tens of billions of dollars worth of servers, chips, and data centers, and they are aggressively selling the stock until Sundar Pichai can prove that this infrastructure will directly translate into higher margins. Furthermore, they faced a fresh $1 billion fine from the EU over Digital Markets Act violations and a high-profile threat from Reddit to block Google's AI training access. But when we dive into the filings and the deeper fundamentals, Wall Street's panic looks incredibly short-sighted. There are two major catalysts hidden in this report that the market is completely ignoring. First, the $94 billion wildcard. Alphabet disclosed a massive $94 billion stake in SpaceX following its IPO, with $80 billion of that subject to a short-term lockup. This is essentially a hidden balance sheet asset that the market hasn't priced efficiently into the stock. As that lockup expires, this stake alone could meaningfully reprice Alphabet's net asset value. Second, the cloud growth. Google Cloud revenue just hit $24.8 billion for the quarter. That is an explosive 82% increase year over year. Even better, Google Cloud operating income came in at a massive $8.8 billion. Let me repeat that. Nearly $9 billion in operating profit from the cloud segment alone in a single quarter. This represents massive, highly profitable revenue visibility. As this cloud business continues to scale at an 80+% growth rate, that CapEx anxiety narrative is going to structurally collapse. Now, let's translate the earnings call. What is management telling us about the future of their infrastructure? Sundar Pichai and the executive team spent significant time defending the capital spending, but the real gem was their roadmap for hardware efficiency. Google discussed their experimental Frozen V2 chip, a custom silicon architecture designed to etch Gemini directly onto the chip. They are targeting a 6 times to 10 times improvement in power efficiency per token by 2028. Translate that, the massive CapEx hike today is a self-funding flywheel for tomorrow. If they achieve that efficiency inflection, their inference costs will plummet, gross margins will widen dramatically, and free cash flow will explode. They are spending heavily now to structurally lower the cost of computing for the rest of the decade. So, what is the bull versus bear case here? The bear case certainly deserves airtime. The risks in AI are real. Chinese AI models are rapidly compressing model pricing globally, meaning the ultimate profit margins for foundational models might be lower than initially expected. The content dispute with Reddit could ripple to other major publishers, starving Google's models of fresh training data. And of course, traditional search monetization faces structural headwinds as users transition to conversational AI interfaces. If capital expenditures remain at $45 billion a quarter without measurable cloud margin expansion by Q4, the selling will deepen. But the bull case is staring us right in the face, and valuation is doing the heavy lifting. Alphabet is currently trading at a PEG ratio of just 0.6. The market is pricing in extremely modest growth for a company whose EPS estimates have been revised upward by over 15% in the past year alone. This provides a massive margin of safety. You have a company with Google Cloud growing at 82%, a $94 billion SpaceX stake, and accelerating 24% total revenue growth, all trading at a discount because investors are temporarily spooked by infrastructure spending. Finally, let's look at the big picture outlook. Today's sell-off is a classic overreaction. It is a CapEx fear reaction to a fundamentally bulletproof quarter. Yes, the market needs a visible ROI milestone to turn the page, and we will be watching Google Cloud margins closely in Q3, but historically, buying Alphabet at a 0.6 PEG ratio when they are dominating the infrastructure layer of the next technological platform has been a winning trade. The verdict: this is a generational buy the dip opportunity. Warren Buffett's Berkshire Hathaway still holds a massive Alphabet position, which serves as a psychological anchor for institutional buyers who will likely use this 6% drop as an entry point. Don't let the short-term panic distract you from the long-term fundamentals. That's the big picture on Alphabet. I'm Kevin McCormick. Thanks for watching, and I'll see you in the next one.